Hi, everybody, and welcome again to another edition of our Market Happy Hour, where CWA's research team kind of likes to share with you, take you a little bit behind the curtain, see what we're worried about, what we're excited about. So today we've got a lot of information that we want to cover with you, so we want to kind of get started on that. Before we do, we just wanted to share with you our webinar disclaimer. Please take a minute to familiarize yourself with the terms. I think our big ask here is not recording and sharing the research outside of what we provide. Joining us today, it's again Lewis Johnson. I'm the Chief Investment Officer of Capital Wealth Advisors, and Zev Abraham also joining us as chatting today, who is our Director of Research. So the specific topic we really wanted to talk about today is kind of how we're thinking about natural resource equities, why we think it's kind of a particularly interesting time to be involved with them, and why we really think that can endure, really kind of for a few reasons. One of the things that we'll talk about is that, frankly, until, say, pretty recently, the sector had underperformed really materially, and as value guys just got us interested because typically as a value equity has the nice characteristic of kind of limited downside and attractive upside. So we're definitely going to be interested in the sector. One of the key reasons that we think is going to drive this is just very simple falling supply that's been driven by too little investment capital going to these sectors, because they do need money to pull these resources out of the ground, and the money has been starved from them. They haven't been spending this. It's frankly one of the key investment aspects of the case. And then finally, again, we really continue to view these as value stocks, and we'll kind of do a little bit of a deep dive to let you know kind of in particular why we've reached that view, and hope you might share that same conclusion. So that's what we're going to be talking about today. And so why don't we just kind of get into the details? So at this point, we'll like to hand things over to Zev Abraham, our Director of Research. Zev's been a good friend of mine and a colleague for many, many years. And Zev has many things that distinguishes with which he's distinguished. And I've always viewed, one of the most value-added part of his background is Zev's long and deep experience in the energy sector. So, I definitely view that he's the expert on this matter. And so, Zev, when I think back about the conversation we were having to get ready for this presentation, the chief takeaway here, of course, is just that energy's really just crushed the performance of everything, here in the last year. Can you just help us understand this?
Yeah, all you have to do is look at this chart, which shows the energy sector versus all the other major sectors in the S&P. Starting from the beginning of the year up until today, I believe. And it's positive by quite a bit. It looks like over 40%. And it's the only one of these sectors that is in positive territory. So that's a lot of information there that needs to be understood, and needs to be understood whether that's going to continue. Because if it's going to continue, at least relative to the rest of the market, we need to think about that. And
no doubt, and it's a conversation we've had, many, many times, which is that, of course, the market kind of lives in the future. So what's really important to the market is not kind of what's happening today. It's what's going to happen in the next 12 to 18 months. And hopefully, as we get deeper into the presentation, you'll start to see why we think the point that Zev just made, the most important one, is we think that there's a multi-year case, which is why we're excited and why we're kind of bringing this message to you today. This was something that I noticed we talked about. I found really interesting, Zev, because basically timing is always important in investing, but really that there was a couple of instances when we did the deep dive on this where the inclusion of kind of a heavier weight natural resource equities was not only higher return but also better diversification.
And we have some friends at a firm called Goring and Rosenzweig who are specialists in commodities, and they put together a natural resource equity index, which includes gold, agriculture, metals and mining, and energy stocks going back into the 1920s. And so we were able to take their data and look at S&P data and United States Treasury bond data, and of course broad commodities or raw commodities commodity futures rather than the equity related commodities, which is indicated in the Goring and Rosenzweig data. And we looked at those over time, and we picked out these two periods just because, well, the 1970s was a very anomalous period in terms of high inflation. And as you can see, the broad commodities actually outperformed dramatically. The commodity related equities also outperformed, maybe not quite as much, but certainly materially. And then, but lately, the last 30 years, investors are more used to, and there's recency bias. You're seeing that the S&P 500 clearly was the big winner, but of late the resource equities have actually performed pretty well. They've beaten the 10-year bond, and that's that should be noted. But what's really more important then is that we then went ahead and said, we really want to look at this over periods, going back as far as we can get the data, and compare if we added more resource equities to a typical RIA mix of investments, which typically people talk about the standard as being a 60-40 equity portfolio, and we decided to look at not just a 60-40 equity portfolio, but so instead you did a 40-40-20, with the 20 being an index of just resource related equities added in there.
And one thing just to highlight that before we get too deep in the weeds on that, as I recall, a couple of the takeaways were that number one, that I guess across the period, that greater diversification of the resource equities did add to returns, while lowering the volatility a bit, and we show the outperformance there. Number one, but the number two, that there were certain periods, certain decades when there was meaningful outperformance. So why don't you kind of help us understand that in the data?
Yeah, I mean that you can see that if you look at columns on the left side. You look at the columns as 40-40-20 in green on the top, and then 60-40. We've aggregated the returns from those types of investments and come up with a number for the entire decade. So 1930s is first, 2010s, which would be 2010 through 2020, is at the bottom, and then of course the furthest right column is the outperformance or underperformance of the 40-40-20. And as you can see, there were 4 of the 9 periods where the 40-40-20 outperformed. And, we're going to talk about which kind of periods are more likely for those to outperform. I think in the aggregate, they perform pretty similar if you aggregate the whole period from 1930 through 1920, with a little slight outperformance by the 40-40-20, but the differences in the periods, like as was said, were significant. And what I thought was really interesting was that 1930s was characterized as a very, very bad deflationary period, the worst deflationary period in the modern era. And then of course 1970s was the worst inflationary period. And in both of those periods, the 40-40-20 portfolio outperformed pretty markedly, actually. And so, it shows you that in this world, where we're in now, and I think Lewis and I have talked before about the over-indebtedness and, how the world gets out of over-indebtedness. And it seems to us that the likelihood of getting out of it through either default, which is deflationary, or, money printing, which is inflationary, are really the two choices. We're going to have, one of those two choices happen. And in both cases, it seems to be, at least historically, that the 40-40-20 did better than a 60-40.
Well, I was going to add just a couple of points too, Zev. If you think about, again, on one of these market happy hours, I forget which one that we last highlighted at this point, but you recall we looked at kind of the Tobin's Q and replacement cost and CAPE ratio valuations. I think it was late 2021. We were outlining, why we had a very kind of conservative equity selection, because equities were historically highly valued. The performance since then of the general equity market's been pretty poor, which is kind of consistent with the prior experiences when equity valuation was that high. And so I'd like to highlight a couple of those. Of course, the Nifty 50 period of the 70s was a period of very highly valued equity growth stocks that did very poorly, frankly, from the peak in 72 on. Of course, the 2000 tech bubble. And that was a period in time when a greater allocation to natural resource equities was useful. Also, the period of 2000, that was the end of the tech bubble. I remember that well. As some of the tech leaders fell, I think the NASDAQ fell 83%. It was a wonderful time to own, these natural resource equities with a nice run room ahead of them. And then, frankly, the reason I'm highlighting this is, of course, we also just a year ago we're at a period in time when equities were also highly valued on a traditional basis. And once again, we find ourselves in a situation where 1 year into whatever kind of cycle we're now in, the natural resource equities are kind of leading the way. So this kind of shows, how we try to think about this, like what could be the merit for including these kind of investments. And the other point I would make, and we'll get into this in just a second, of course, is one of the most important key aspects of that kind of investment decision is kind of where are we in that cycle. And it's great that these things have worked in the last year, but what's more relevant is what they might do in the future. That's what we're going to talk about. The key driver, there's a lot of things that we, could talk about, but, I can tell you, at least in all the decades, I guess I've been an investment analyst watching these sectors, supply growth is always what you care about, because demand growth is going to be whatever it's going to be. But new supply comes from spending. This takes years to unfold. So that is one of the reasons when I look at what's happening in the resource sector, I feel confident about a multi-year outlook, because the capital spending has lagged so dramatically. And I think you've made this point, Zeb, in particular about energy, just that if you don't kind of keep pumping that money in the ground, the production will decline.
Right, and the question is, why has capital been underinvested? And there's the traditional reason, which is prices. There was just too much capital that went into the business, and too much production. Prices fell around 2014. But then the other more sort of insidious problem is that the world is trying hard to transition away from traditional energy and create a world where traditional energy isn't needed, and yet it continues to be needed quite dramatically, and will be, in our opinion, for quite a long time, more than a decade.
I think we can show this visually on the next chart. What we're looking at there, Zeb, is the darker line is the actual spending, and then the kind of couple of red lines basically show that if you were on path spending to kind of replace production to keep it from shrinking, that's where the spending would be. So it seems like there's a very meaningful gap that's developed, which is why we're so with falling supply, it's why we're bullish on the supply outlook and therefore the pricing outlook.
Yeah, I mean, this is a really, really dramatic chart, and the most important takeaway is the spread at the end there on the right side between the blue line and the two red lines. And basically, the blue line is what spending is, in fact, and the red line are two different estimates of how much spending the industry needs just to keep production flat. The lower line is if you use the more traditional 6% decline rate that the industry has had. And then the higher line, the more maroon line, shows if you include the 15% higher decline rate from shale wells, which are taking up a higher portion of the new production. But in either case, the spread is pretty large. And what it doesn't take into account is that that's just keeping production flat. Mm-hmm. Despite all the efforts to limit hydrocarbon usage and bring it down, there are very few analysts and prognosticators who are looking realistically at the market and think that the traditional hydrocarbon, natural gas, oil, gasoline, heating oil, et cetera, is not going to continue to grow for at least another decade. So that this doesn't even take into account that.
Well, the other thing, of course, driving that, I think it was what, just maybe a year and a half ago, right? So that the largest North American natural gas producer emerged from a long and painful bankruptcy because the natural gas price had gone from, what was it, $16 to $1. Which is one of the chief things that frankly drove investment spending away from this sector because companies were going bankrupt and the returns were frankly horrible. But as a natural resource investor investing in cycles, the time that you want to invest is right there at the period where you can kind of forecast this kind of multi-year need to rebuild capital spending because natural gas and energy, it doesn't come from the sky. Somebody's got to poke a hole in the ground and pull it out. But if you take a look, I think at the next slide, this shows the economic impact of how this is played out in the equity market. So that basically, if I'm reading this correctly, just shows that the green sector, which is sector weights of the S&P as a percent of the total. So energy peaked out at 16%. 10, 12 years ago, and it fell all the way to 2%. So a mind-blowing collapse in the representation of these equities in the sector. This is the opportunity, I think, is it not?
Yeah, exactly. And for those who have seen this dramatic outperformance recently, which you can see in the spike up at the very right side of the chart, it's still well under the any of the points in time of the past 30 years. And so, we would think it has a long way to go. And the way we show that a little bit, at least, is in the table below, where we're looking at, in 2007, at the peak of the sector weighting, when the energy sector was at 17%, believe it or not, it was contributing 57% to S&P earnings. I mean, there's a lot of companies in the S&P that get really large valuations that don't actually contribute earnings. The energy sector does, and yet only got to 17%. At the very bottom, when it was 2% of the S&P, it was still generating 16% of S&P earnings. It's now back up to 30%, yet only contributing to 5% of the S&P weighting. And of course, next year is to be seen. The market is thinking that it's actually going to decline as a percent of S&P earnings. And that's because the S&P earnings are supposed to rise 10%, and they're expecting energy earnings to decline next year with lower commodity prices, something that we both think that it's unlikely that will happen from the energy earnings side, and also the 10% S&P earnings growth is going to be tough to achieve.
Well, so to kind of summarize, here we're kind of dwelling a little bit on energy, just showing that, of course, the sector has collapsed as the economics have been very poor. This is driven underinvestment. Underinvestment tends to drive higher prices in the future. When demand normalizes, it seems that demand is normalizing, and this could be the multi-year opportunity, at least as we see it, which is why, even though the equities have performed pretty strongly in this last year, frankly, we think this could, just be the start of a much more enduring capital cycle. And I think on the next page, we kind of give an example of, let's say, within energy, how we think about one of the more attractive areas to us, which is kind of the U.S. natural gas sector. Why don't you walk everybody through that, Zoe?
Yeah, at the end of the day, personally, I like value and things that are cheap, and that will substitute for things that are more expensive. And natural gas, for the past couple of years, but particularly now, is the cheapest form of energy, and all forms of energy are in need. There is an energy crisis in many parts of the world, and the best way to solve that is through, or rather, the cheapest way to solve that is through domestic natural gas, which is the black line on this chart. These these numbers are calibrated such that you're looking at the BTU value of each of these different forms of energy: coal, oil, European natural gas, and domestic natural gas. And as you can see, because of the Russia crisis, and even before the Russia crisis, European natural gas had gotten very expensive. It's a closed market. It has trouble bringing in product, and then coal and oil, surprisingly, are trading quite close to parity. Coal has come up somewhat now because it's needed. It's able to displace gas in some applications in Europe, but it's still twice the value of domestic natural gas. That spread, we believe, will close, and the way that it will close will be in favor of U.S. domestic natural gas moving up as the U.S. builds more facilities to create liquefied natural gas, which will be able to be exported from the United States to Europe to solve their gas needs. And so that black line should move up. Potentially the green line will move down, and there's a really great profit opportunity for the U.S. natural gas producers.
So basically, what we're saying, of course, is we've discussed the supply shortfall, in energy, and here what we're outlining, as Zev was saying, U.S. natural gas in black is clearly the lowest cost substitute of all these things, which is one of the reasons that when we look within energy, we frankly see there's some nice opportunities within that. And maybe this is a nice opportunity, Zev, to kind of do a little bit more of the deeper dive that you and I were discussing on valuation on the next page, where I'll let you kind of walk into that. But one of the things that I suppose when I look at this that it kind of appeals to me is this idea of having kind of multiple ways to win, or kind of free optionality, where I always prefer those investments where there's a certain amount that you're identifying that you're paying for, but there's unquantifiable and potential upside that if two or three things work your way, can help it be much more of those kind of free optionality framework. So why don't you talk a little bit about this kind of natural gas example, for instance?
Yeah, so the SEC requires E&P exploration production companies to do a discounted cash flow of their proved reserves. That's the green box there, or the green area. It's typically known as P1, proved reserves, and they're audited, and they have to use certain metrics to create a discounted cash flow. They discount it back at 10%. They have to use the gas and oil price that they're going to be producing at the average price for the prior year. So for 1921, they'll use the average price for 1921. And that's a great metric to look at a company and say, well, we know what their proved reserves are worth. What's the stock price trading at? Mm-hmm. But every company has probable reserves. Those are in the amber or yellow, and then possible reserves. And those are different classifications that geologists give for additional reserves. And they might not be 100%, but there's going to be some of the probable reserves will in fact turn into proved reserves. Some of the possible reserves will in fact turn into proved reserves. And so,
excuse me. So on this point, like I know there's you're going to show an example of the price curve on the next slide, but I guess maybe one of the reasons for our excitement is there's a number of equities we've been able to identify that it seems like the entire value of the current share price is kind of in that green 1/3, which is kind of the most certain based on the data that we can find. And that's where that free option comes in, is there's an option on higher prices or production growth and so forth. I mean, maybe on the next slide. I mean,
there's
mm-hmm.
there's two free options here based on where the companies are trading, and we're seeing really, really anomalous cheap stocks in a lot of ways. Despite the fact that these stocks have appreciated a lot, that they're on some of these measures, they're actually looking cheaper than they were 2 years ago. because of the way oil and gas prices had moved up. So the two free options, as Lewis mentioned, was one, you have the free option of the probable and possible reserves. And then the second is you have the free option of higher prices. And that's not higher prices that we think might happen. It's actually higher prices that already are embedded in the futures curve, which we'll show you on the next chart. And this is the futures curve, right? So the way this works is you can go out and buy or sell oil and gas out to 2034, and this is a price that you can pay for each of these periods. And so the curve shows the green line is what the current curve is today, or I think we took it yesterday, and near term prices, $8.50. And then it comes down pretty dramatically, but still stays in an average range of about, $5. And then goes back up to $6. And then of course, that's much, much higher than it was 6 months ago. And, so when you look at the value of a company, its value is how much it can sell its oil and gas it's going to produce over the next 10 years, right? So this is relevant. How much it's going to be able to price. If prices go up in the out years, it's just as important as if it goes up in the near term. And so this is an important concept to keep in mind. But the more important concept, I think, is on the next slide. Lewis, are we ready to go? Or do you want to?
Oh yeah, no, definitely, because that's exactly where I was going. Is that is again to just try to kind of keep this simple. Remember, we showed that earlier pie chart with kind of three potential sources of value for the companies that are trading right now. With in some instances, we've identified companies where their entire market cap is explained by just the most, say, conservative and well-known third of that. Number one, and then number two, illustrated the concept that, of course, as long-term prices go higher, that can be higher value for the companies. And then the third one, you talk about this here, Zeb, that basically says that 1/3 of say that pie that we were talking about represents a lot of the current value of these companies. Even that value is based on an old price, and this example kind of shows that. So why don't you help people understand that?
As I said, when a company does its SEC PV10 calculation, which is required by the SEC, and there's formality to it, but it's really as accurate a view of proved reserves as you can get. It has to plug in a price that it's going to receive in for these future cash flows. And what the SEC does is it says, well, you have to use the price that was the average price for the prior year. And so in this case, we took a company, I guess I'm not allowed to tell which company it was, but its average price was $3.60. You can see there, it's that blue line. But the current price of natural gas is the green line. And so if you were actually to take the green line prices and plug it in to the production that is going to, the proved reserves that are going to be being produced by that company over this period, you would get a much, much higher value than is embedded in the number in their financial statements. And so, as I said, that's a free option. That's an amount that actually, if the company chose to use a hedging program and lock that price in, they could. And so I think the really important takeaway is just that, we've been looking at, this is a prime metric that we've used for valuing these companies for the 20 something years of my career. And I don't recall ever seeing a situation like this where there was such good value embedded in the PV10 value versus the actual pricing.
Well, yeah, and this I think is an important part. I can promise you that when Zeb and I have these conversations with our base of advisors, it's one of the things that we try to educate them on, because I can tell you that in the time that we've been doing this, working with retail clients, what we find is that it's not unusual for our individual retail investors to be fixated on the news, kind of what's happening every day. And the point that Zeb's making here I think is a deeply fundamental one that's very useful for us as a research team, which is basically that, this is a concept that kind of goes beyond the news. This is kind of what you're paying for these entities. And so think back about the big point that Seth was making is that there are a number of these equities that we've been able to identify and that we're excited about that where, just that proven and probable bit that is the most highly disclosed and has the greatest amount of likelihood of coming to be at the reduced price deck is enough to explain in many cases, or in some cases, the whole value of these publicly traded equities. It means that any kind of course, price increase you get in the future is free. Any kind of production growth is free. Any kind of expansion of them taking, let's say, that what are now more speculative aspects of their resource base and actually turning that into production. That could really be a source of value creation. So of course, nobody knows what the future holds, but you know that us as value investors, whenever we feel like we are picking up, free options, and when we do have limited downside, it's a sector that we're going to be, excited about. We've kind of done a deep dive, nerd out a good bit. I thought, we could just maybe highlight this a couple of points of, and then maybe just chat a little bit about, how we're looking at this opportunity, kind of in retrospect, in terms of based on our careers. Like, I think, we both were in the saddle through, the Asian crisis and the tech bubble, and then that collapsed, and that was a wonderful resource cycle. And then for the 13 years from 2008 until I guess last year, very much tech driven, where resources were kind of very much in the backseat. It looks like that cycle is changing. We've talked a lot about the new leadership cycle that we think is underway. I think we've been beating that drum for the last year or so. So we just really wanted to take this extra time, and you guys have been very kind with your time to sit and listen to all this about why specifically we are excited about resources now. Why we think that there are many reasons to have a favorable outlook based on their valuations, that why we think this could be a favorable time to own them because of the dramatic supply shortfall that frankly should take many, many hundreds of billions of dollars in many years to fix. And that until that problem does get fixed, it would be typical to see higher prices that kind of create the economics such that people have the money to invest in the new supply to get the supply growth that is demanded by those higher prices. So when we look at kind of all these aspects, this is super useful for us because, we don't have any insight into the headlines, that are flashing across our screen, and some of them are pretty terrifying. But this is one of the things that we as value investors will rely upon. It's not so much that we have, brilliant insight to the future. We know exactly what's going to happen. We kind of look at it in the converse way. We say, we'd rather we draw confidence from owning items that we believe have limited downside, almost regardless of the news, because they are trading at a historic low valuation, meaning that if we're wrong, we shouldn't lose a lot. If we're right, perhaps we could, do really well. And so that's the confidence that helps us face the markets. Again, it's not that we know the future, we're projecting headlines. It's that it took many years and horrible returns of specific bad drivers to make the economics of these businesses challenging to a very extreme point, and that it's going to take a long time to fix it. I mean, how else are you thinking about this?
Yeah, well, I think the other thing that we should touch on a bit is we've been talking about energy, and there are a lot of other resources, and one of the knocks on energy is that we're going to be going through this energy transition, that there's going to be less need for energy, and that's sort of like the bear case on energy. But guess what? In order to wean the world from the need for energy, which we think is not going to be nearly as easy as everybody thinks, there's going to be a tremendous call on other resources, particularly certain types of metals. Copper comes to mind, lithium, aluminum.
Well, and there's another example too. Of course, energy permeates everything. Modern agriculture has been built upon the foundation of very intensive use of chemical fertilizers. And one of the most primary fertilizers is extraordinarily natural gas intensive. For instance, ammonia is a kind of a key feedstock that goes into many fertilizers. And 1 ton of ammonia takes 33 and a half tons of natural gas to make that 1 ton of ammonia. So there has been incredible price increases in the price of key inputs to agricultural commodity prices, which are going to result in higher commodity prices due to the higher cost to make these commodities. So there are definitely companies that we've known and followed for many years that have advantageous cost positions and can profit from those higher prices. And this will cause, to your points of changes and challenges in the nature and the structure of, for instance, the agricultural sector and its suppliers. So yeah, definitely. We've talked a little bit about energy here. I mean, those of you who've been following our work, I guess, for the last 3 or 4 years know we've been beating the drum on natural gas very enthusiastically during that time period, and we continue to be positive on natural gas, which is why a little bit of this is kind of centered on the natural gas example. But to Zev's point, typically commodity cycles are ubiquitous across kind of those 4 main categories, as Zev mentioned: energy, agriculture, base metals, and frankly, precious metals as well.
Yeah, I agree with them entirely, and I think the opportunities are going to be out there, and they're going to be across the different sectors, and they're going to be, very, very surprising because, we've studied some of these issues in terms of how much of certain different resources are needed to move the world to an electric vehicle fleet, to produce enough windmills and solar panels in the Western world, trying to get them away from their almost entire supply chain that comes out of China. And it's really going to be a historic call on certain non-energy commodities as well as energy commodities to get those things done. And so those who are worried about maybe recession, the decline in demand from recession, the fact that China, which was really the main driver of the last commodity cycle because of its rapid industrialization, and it really moved up the curve in terms of per capita use of commodities, that won't be happening this time. But we think that will be offset and more than offset by this massive continuing effort to decarbonize and move forward with the electricity transition, even though it's really kind of sputtering and having trouble.
Well, there's 2 points I would add on that, Zev. One, in terms of course, the Russian invasion of Ukraine, the Russia and some of its, kind of allies and so forth, in many cases are a huge proportion of the global supply of key resources. It's European natural gas, it's platinum, it's palladium, it's diamonds, it's a whole host of commodities that Russia is very, very meaningful. And so the sudden loss of that product in the marketplace has created, a huge shock. So it's very much a different cycle than the Chinese driven cycle that you're talking about there. So we're very cognizant of that. The second point really to make, has to do with diversification and the kind of portfolios that we're trying to construct. I mean, frankly, this last year has been exceptionally challenging. If you take a look at the performance of the 60-40 portfolio, and we demonstrated performance of that kind of typical portfolio over time, I think in this last year, it's been the most challenging year since I think 1931 for that portfolio, which typically provides much better diversification than it has this year. And of course, the reason that diversification is frankly under pressure is bonds have been under pressure due to essentially an inflation shock. And of course, that's where the natural resource equities come in, is the particular shock that is hurting in this last year is really caused by this natural resource sector that's a beneficiary of the shock that is disturbing that portfolio construction. So a key aspect of how we're looking about this and thinking that we may be able to improve our portfolios by including more natural resource equities is that they are one of the few asset classes that are actually benefiting from the shocks that we're enduring right now. And that's another kind of key portfolio benefit that we think, if we've got our timing right, if we've got the view on supply, and if we've got the view on valuation correct, and it's our view that we do. Well, so again, everyone, you've been really kind.
These are really exciting.
Go ahead, Zeb.
I was just saying, these are really exciting times. We're, Lewis and I started our careers in these silos, and so we know them really well. And this, we've been in bull markets for commodities. This one seems like it's got a lot of legs and could endure for quite a while.
Yeah, well, I totally agree on that, Zeb. I mean, the market's definitely always changing, but the one aspect that I've always relied the most on in developing a favorable multi-year outlook in the rare occasions that we could, I think this is one of them. It's always supply driven because no one knows what's going to happen with demand. But if people, but it takes somebody spending money over the course of many years to create supply growth. We have the opposite of that. And number one and number two, the great thing about kind of beginning from such a supply deficit is that your thesis could withstand some pushback on the demand side. So demand could be disappointing, and still the cycle in terms of a multi-year basis can still have a lot of power in it, because particularly when the supply shortfalls are so extreme. So, certainly we don't have a crystal ball on how we look at the market. But again, if you think about the problems we're trying to solve on behalf of investors, we're trying to create thoughtful ways for people's money to be defensive to shocks and downturns and recessions and so forth. And at the same time, find ways to help the money grow. And so one of the things that I certainly get up with a spring in my step these days is that, as I've said, we're kind of got thrown back in the briar patch of the areas that we were so familiar with for so long, is that, good old fashioned, natural resource supply driven cycle. And the final thing I would say on this is this, none of this is a short term forecast about this going to happen in 6 months or 12 months. But I do feel very, very strongly that the nature of these supply drivers are such that, in my opinion, the new leadership groups of the new equity cycle, in my opinion, are going to be driven by these, which is why so often talked about, or if you took a look at our portfolio construction, we have almost no tech exposure and so forth, because we really think that was the exposure, that was the leadership the last cycle. And we think the real winning portfolios of the next cycle are going to have more exposure to what we think are the next cycle's winners, which is why we're excited. So like I said, you guys have been very kind. Just wanted to highlight for you a way that you could reach out to us. Send us an email, please, with any kind of questions you have. We'll be glad to get back to you. Any kind of questions or comments, don't be bashful. We pay attention to all of them. If there's any way we can, improve this, any topics you guys would like us to take a look at in the past, don't be bashful.